Sankalp and I represent PMS IIFL World. We are one of India's leading digital, investment platform. We have always, spread the message of informed investing, and in keeping up to the tradition, we have two very special guests with us today from IIFL Asset Management, Sashi Singh and Mitul Patel. Sashi heads sales and Mitul is the fund manager at IIFL Asset Management. So today, we're going to talk about a very special kind of a theme, and we have always maintained that at PMS IIFL World, our view is somewhere cautiously optimistic in the markets, and in that extent, we have today these two very special people talking about the markets and how to approach the markets and what are their strategies. So over to you, Sashi and Mitul. Please welcome to the show, and please present whatever you have to. Thank you.
Thank you, Sankalpo. Good evening, everyone, and thank you for joining us today. As Sankalpo said, it has to be a very special talk when we talk about investing into equities when Nifty is at 13,500 plus levels and continuously rising. Is the market expensive, or should we look at equities? Should we wait? Is the market going to fall? Will there be a correction which will give us an opportunity to invest? So these are some of the questions which we try to address and give solutions for these kind of issues that the customers are facing today. But before that, let me just take a seat back and understand why we are at today at this level. Right from 11,000 Nifty, and we have been saying market has run up and we should expect a correction. So those who did not participate in the equity market or did not allocate to equities and were waiting, kept waiting for a correction and missed this whole run up in Nifty. Now, there are certain reasons why markets are going up. And 2-3 very obvious reasons that we see is we're seeing positive signs or positive news on the COVID vaccination. Recovery on the COVID side is far better. So it doesn't look like such a huge pandemic which would affect people, and which has also led to the economic recovery happening. And we across all of us, we're seeing businesses opening up, and the Q2 results of corporates have actually been very good, showing that recovery is on its way. And this is all also aided by the policy actions taken by the government. We've seen in the last 9-10 months, there's been a 115 basis points cut in the rate, so which has helped people and corporates recover faster, which was the impact due to COVID. So all these things have helped market run up. Also, global factors that if we see that US is on a recovery path, but Europe has not been. Asia is positioned very well, and within Asia, India is positioned quite well, and therefore we see a lot of interest from global investors coming into India, which is adding to this. So is the market expensive, and should we wait for a correction? Yes, the market is not as cheap as it was at 9,000. But we are also seeing healthy growth in certain companies. And if the companies are a little expensive, but you see growth happening, it is okay to invest at a little higher valuations. Why is it okay? Because there is no other alternative. If you look at other asset classes, would you be able to generate the kind of risk-adjusted returns that you would from equity, even after taking this risk in equities? No. So fixed income, gold, real estate, we don't have an answer. So the solution is equities. What is most important is then to remain allocated in equities. But the risk looms large. And how do you mitigate this risk? So we are saying, while Mitul will talk about how we mitigate the risks in our equity portfolio while investing, what are the research parameters we look at, and how do we ensure that we are in the best stocks. But apart from that, the best way we feel to remain allocated to equity and still have a peaceful sleep in the night is to remain hedged in equities. And what do I mean by that? So while you invest in equities, you hedge your equity investment, which we do in one of our products called IIFL MultiCap Advantage PMS. So we run two portfolios, IIFL MultiCap PMS and IIFL MultiCap Advantage PMS. MultiCap PMS is a pure 30, 25, 26 stock long only equity portfolio, while MultiCap Advantage has the exactly same equity portfolio, but of your 100% paid, only about 92 to 93% is invested in that equity portfolio. The balance 6 to 8% is utilized to buy Nifty Put options to hedge your risk on the portfolio. So if the markets were to show a sharp correction tomorrow, you can at least sleep tight that your risk was hedged. It is not a complete hedge, then it would have become arbitrage, but it is just a hedge to cover you from the market fall. Just to give you some example how this helps. So the 1 year performance, if I see, of our multi-cap PMS was 20%. As of yesterday, if I see 1 year performance of multi-cap PMS is 20%, whereas the 1 year performance of multi-cap advantage PMS is 29%. Even better, if I see YTD performance, that's when we started seeing the market fall. The multi-cap PMS was 15% performance, whereas multi-cap advantage is 25% performance. And why I'm talking about this performance is, so whenever the market fell, the put option gave you positive returns to offset the negative returns given by long equity, and that's called hedging, and that's given you the advantage. At the same time, the 6 to 8% cost that we pay for put options, if the market keeps going up, these are 3 year put options, so then you are incurring a cost of about 2.5% every year for hedging yourself. So if the market keeps going up, your return is less than the normal equity portfolio. Like for example, if you see the last 3 months return when the market has been going up, multi-cap PMS is 21.8% return, but multi-cap advantage is 17% return. So that's how when the market keeps moving up, you might witness a 2.5% lesser return than the long only equity. But when the market falls, you do not fall like the long only equity. So you are benefited over a longer term on your CAGR returns. And that's what we want to explain today, because in this market going forward, one, we are saying you should be allocated to equities, but at the same time, we're saying markets have run up, corporate earnings are catching up, but it's a risk. So to take this risk, you should hedge yourself. While even on the equity portfolio side, Mithul will explain you in detail how we are managing to ensure that the portfolio is superior on a risk-adjusted return basis. So I will now hand it over to Mithul to talk to you about portfolio details on the multi-cap advantage, as well as talk to you about how we do the hedging and the put option trading. These are 3 year put options, and I should caution that the hedging in portfolios is done once in the month. So even if you invest, say, on a 3rd or a 4th of the month, your hedging will happen only on the last day of the month. Till then, the portfolio remains unhedged. Also, since these are done through Nifty Put options, there are some residual amounts which remain unhedged because Nifty Put options are of a certain value, which might not match with your investment value. So,
right. Thank you, Sachin. We will again get you back, require you again for the Q&A round, so don't go anywhere. Mithul, before we begin, I just want to tell you, we did this poll. I asked if I'm bullish on the markets, which of these instruments will I use? And majority of the audience today says that they'll buy a call option. So they're right there in their understanding of these products. However, do enlighten us a bit more on why a cautious optimistic stance is required in the market now, and what is the overall view of equities. Over to you, Mithul.
Thank you. Sankalpo, can you share the presentation, please?
Sure, of course. So you have the controls. Over to you, Mithul.
Okay. Sorry. Okay, hello everyone. So thank you for joining in. And, I want to talk about just a little bit about the market and how, as Shashi mentioned, our view is cautiously optimistic on the markets and why we need to, have, this multi-cap advantage option with us, for having risk-adjusted returns during these volatile times. But, just to start off with on the markets, obviously talk about the COVID situation. When you look at, our cases, a 7-day moving average cases, they have actually dropped significantly. We are in this 35 to 45,000 range per day currently. And, more importantly, the deaths per day have gone down from a peak of 1,200 to 500. So, I was a bit worried, in the middle of November because of the festival season that, we will, because the people were going out and there will be a new second wave to speak of would come through. But, it's been now almost 22 days since Diwali has passed and we are not seeing a major spike in the cases. And mostly the testing has also been quite steady across the country. So, so this gives us a little bit, but more optimism in terms of that we won't see a second wave. I don't think we will see a risk of a second lockdown. That is extremely minimal. We might have some small lockdowns here and there, like night curfews or, Saturday, Sunday lockdowns. But that will not, impede, economic activity. And obviously, this last 8-9 months have been, these 8-9 months have given, most of the states and governments to, set up adequate healthcare infrastructure as well. So, there have been some cities that are seeing some spikes, but overall, if you look at, on a countrywide basis, we are pretty okay. And, the Western world is seeing some spikes as well, like US, UK, France, Germany. But, there they have certain level of lockdowns, but their lockdowns are not, the kind of lockdowns that we have seen in the past. Their lockdowns are, much more easier. There you can go to a restaurant, at 10 o'clock in the night. You just can't go in big groups. Economic and industrial activity continues. Offices are open. Shops are open. So their lockdown is not the kind of lockdown that, we have experienced. So that way too, and Western world is also a little more geared better for the vaccine. As we saw yesterday that I think a 90-year-old woman was the first woman to get vaccinated in London. So I think that situation is progressing, and it will progress fast in the Western world as well. So on the COVID front, we are not that worried that something will get us off guard, but we still have to be a little more careful as we move along. On the economic recovery track, I think this is an important graph that everybody should focus on. There has been a V-shaped recovery, and it is as of now it has been a bit sustained, which is quite positive. When you look at exports, when you look at two-wheeler sales, power demand, GST collections, passenger vehicle sales, and rail freight, those indicators, which are just on a broader basis, encapsulates how the economic activity is progressing. It shows good optimism. We look at the car and two-wheeler sales. Obviously, there is some level of pent-up demand here, and the fact that people are a little hesitant on buying, a little hesitant on using ride-share facilities such as Uber and Ola. But just to put it in context, last 2 years for the auto industry have not been great. So the level of pent-up demand is also a bit lower here, and therefore this if this sort of sustains over the next few months, it is quite positive. GST collections have been close to 1 lakh crores over the last 2 months. That has been positive as well. The finance minister recently was in a conference that she sounded quite confident that over the next few months we will see this number being quite sustainable. So that should aid government expenditure as well as going forward. Power demand as well, pretty solid. Exports is good, aided by IT exports and pharmaceuticals and chemicals. So that on that front is also pretty good, and the import bill is also coming down. Therefore, our current account deficit is also pretty good. This is just a little bit of a deeper perspective into auto sales. When you look at this graph, which is there from October 2019, that was way before COVID. You can see this number rising, and if we see that these numbers improve or sustain at a positive territory, that is quite positive as well. Here on the retail loan growth, obviously that has been low, but I think that his situation has changed quite dramatically in October and November. This graph is still September. Now we have spoken to heads of major housing finance companies and banks, where they have seen record disbursements in housing loans in the country, and that is driven by the fact that as a cost of owning a home on an EMI basis over the last 6 to 9 months has come down by anywhere between 20 to 30%. When I say that, it intuitively might not make sense, because as we know that anywhere in the country, prices have corrected between 5 to 15%. And, as Shashi mentioned, that there have been significant interest rate cuts that have happened by the government, by the RBI. And therefore, Kotak Bank offering housing loans at 6.75% or SBI at 6.9%. These have been historically low rates real estate players, and it is happening it's happening in segments which are greater than 75 lakhs and less than 2 crores. So there it's being pretty strong, and it's across the length and the breadth of the country, right from Bangalore to NCR to Bombay to Hyderabad and Chennai. So we are seeing good traction there. There too, we are seeing a positive traction. Here is something that we all feared for a good period of time in April and May. When you look at unemployment data, that number has had gone up sharply to close to 25 to 30% levels in the month of April and May. But if you see this graph, this data has kind of come down to pre-COVID levels, and that has also been corroborated by different banks, because banks who own your salary accounts have real-time data as to how bad the situation is or how good the situation is, and there they are seeing extremely minimal impact of salaries being credited into accounts, and that too has now close to pre-COVID levels. So there also we are confident that the fear in April and May of severe job losses, severe salary cuts, etc. Have not taken place, or might have taken place over a very short period of time, and now have returned back quite gradually. So that also gives us a little more hope as well. This is also an interesting chart, which I'll talk about when we discuss the portfolio as well. The manufacturing PMI, this chart dates back to last 5 years, and manufacturing PMI has rose to 58.9 in October as well, and it is the highest since October 2007. Of course, it might not stay there for some time, but because of a lot of government-related incentives, etc. We are seeing a significant amount of manufacturing pickup, and services has lagged, obviously, because of the fact that as we just anecdotally, restaurants, theaters, etc. Those will take some time to catch up. But manufacturing PMI is on a strong swing, especially with the government's focus on Atmanirbhar, with a lot of PLI schemes coming through, a lot of tax incentives given by the government for new capex, where the new capex now you have to pay only 15% tax on it. So that all these things are kind of slowly coming through, and people are taking advantage of lower interest rates to do these capex. And just in terms of government policy action has been supportive. it could have been more than it could have been better than what has come. But certain reforms have been quite good, whether it's production linked incentive, which is the PLI scheme, which actually affects industries from the pharma sector to the domestic manufacturing as well. Chemical industry also benefits from production linked incentive, auto ancillaries. So this is a very big scheme that government has announced, and it went slowly. You are going to see some announcements on different sectors as well. Labor reforms have been taken, have been improved so significantly. Land reforms have happened over the last 6 to 9 months, and expanding infrastructure. So one of the biggest ministries that have actually spent their money and their quota of money over the last 9 months has been the roads industry, roads ministry, where they've actually done quite well. And now the government is telling all the other ministries that by the time March comes, they need to spend their quota of money, otherwise they will have to dividend it out. So therefore, the manufacturing PMI, this graph that I showed you earlier, could sustain as PSU start doing their capex, starting now till March as well. Then that should also give more fillip to jobs and to other ancillary sectors such as steel, cement, etc. So that also gives us a little more optimism. Now, just in terms of what has happened over the last 6 months in terms of actual fundamentals, which we are all interested in as market participants. So Indian corporates, to our mind, have done quite well in the first half of this year. When you look at this graph, revenue growth, you take net profit growth, excluding oil PSUs and excluding PSU banks, they have been much better than what you would have expected. Even I did not expect that the Q2 numbers, for example, will be as good as what it came out. So Indian corporates have done quite well in terms of the rebound, in terms of revenue, and they've really tightened the belt in terms of costs as well. And there you have seen a significant amount of margin expansion for a lot of businesses, and that has aided profit growth, or has arrested the decline. And that also has related to the markets rising as well. So when you start the year in April, May with an expectation that the Nifty EPS is going to be X, and in 6 months' time you figure out that this number is going to be, say, for example, 20%, 30% higher than X, then the market reacts quite viciously. And that is what has happened, because right from IT, right from banks, pharmaceuticals, auto companies, chemical businesses, etc., across the board have done quite well in terms of profits. So that has also fundamentally triggered the market reaction as well. And this is what I mean, is that earnings estimates have been revised upwards, and that too extremely sharply. In a very short period of time, when you go from minus 13% to positive 4%, that is a substantial swing. That is roughly a 23% swing that people have factored in very, very, very quickly. And that's why you have seen that in the month of November, the market was up 11%, just when the earnings season got over. And that is why you have seen that the markets have rebounded sharply. Here is a good snapshot of 1,260 companies, listed, and their performance as well. So when you look at how things have shaped up, on a total basis, it has been significant. So minus 44% in June, and then 16% in September. So if you would have asked anyone regarding what the number could have been in September, this number would have been in the negative, and now this number is positive. And this is actually hard facts that have happened. And obviously, since now every month is an improvement, you will see that the Q3 will be better than expectation. Obviously, that has been baked in a little bit as well. So therefore, we will not see we will see is upgrades coming in. So this is a chart which is quite interesting. Obviously, these are quarterly charts over these are quarterly charts. This is September 20 GDP degrowth that has happened. We expect the December quarter to show a little bit of positivity, and March should be positive. Obviously, March 21 will be very, very, very large growth because of the negative base that has been there. But as you can see, it will taper down a little bit, and when reality sets in, and therefore, that is why we are cautious a little bit on the economy, cautiously optimistic on the economy. We think that this is the kind of scenario that will play out, but there are a lot of other risks that we need to watch out for as well. So coming back to economy. So we expect this trajectory to continue, but I think after the March quarter, when you will see that the banking system and the restructuring that will take place, when a lot of the industries that are really down and out right now, such as say cinema, services companies, retail companies, once they come out of this problem, we will all be focused on the next year's growth. And if the next year's growth is not up to expectations, then there could be some volatility in the markets. So therefore, that is why we are advising that whenever right now, if you're taking looking at into investing in equities, you should have a hedged option, which is actually a very smart way to play this rise in the market that will happen in the coming months as well. But you are also insured against a fall as well. So think about it. I like to give this analogy. Is think about it as buying stocks, but with some level of insurance. Now, obviously, you don't want to use this insurance ever. Like when you take a medical insurance, you don't want to use this because you don't want to get hospitalized and use this insurance policy. But the fact is that as you grow older and older, and here as the markets keep rising higher and higher, there will come a time when you will have to use insurance, and that is why you need to protect yourself against volatility. And as we have seen over the last 3 to 4 years, markets have given certain level of shocks, though it has rebounded, but certain level of shocks have come through, and that is why you need to be protected for certain volatility that comes our way. And the future obviously is looking much better than the last 9 months, but still there are a lot of unknowns. People are factoring in vaccine related recovery. Yes, vaccine will be available or should be available to most Western countries. India will also get it, but how much time longer will it take for it to ensure a decent amount of the population? That waits to be seen. Will there be any side effects? Also has to be seen. So a lot of these things can spring up and can affect markets and sentiments as well. Though the recovery is in place, because we have run up so sharply, we have to be a little bit more careful as in terms of how you want to enjoy this equity journey. And in our view, a risk adjusted way of participating in equities is the way to go, and therefore we are recommending the MultiCap Advantage PMS. And coming back to this portfolio, as Shashi mentioned, this portfolio is roughly 90 to 92% of this portfolio will be in stocks, which will be exactly like the IIFL MultiCap PMS, and that has done quite well as well. So 90 to 92% of your portfolio should deliver better alpha over the market, but only when when the market is a bit volatile and we're buying 3-year puts, long dated put options, where the annual cost is, as Shashi mentioned, 2 to 2.5%. Whenever there is a sharp drop in put options, and this is what we experienced in March, is that whenever there's you've paid say 100 rupees for this put option, and and that's what we say, for example, paid before March, and when COVID hit us and the market corrected sharply 30 to 40% in a very short period of time, the price of these put options, this 100 rupees went up 3 to 4 times, and we were very quick to react when this fall happened, and we realized a substantial amount of value for our investors. So the 92% of the stocks that of the portfolio which were invested in stocks fell along with the market. But this 8 to 10 percentage points of the portfolio which was invested in put options went up 3 to 4 times. So you were insulated from this fall. You did not fall at all, or did not fall as much. And when the markets moved back up, you were again enjoying the rise in the markets. So this is, as markets keep on rising, this is a good level to kind of have a reality check and hedge your bets against these volatile times which might come through. And that's why we are recommending this PMS. Our portfolio also is constructed in a very well thought of manner. Since it's a multi-cap PMS, even the advantage one, the 55% of the portfolio is currently in large caps, and the balance is between mid caps and small caps. In terms of the sector as well, we are 33% of the fund is in financials, where we see that cyclical recovery is under play. The things that what people were expecting, in April and May, and perhaps in August as well, what the credit costs will be for the banking system. It's not going to be as bad as what people expected it to be. The incremental restructuring because of COVID for major of these private retail banks are going to be anywhere between 1.5% to 2%. And if that is the number that comes out in the December and March quarter, then our belief is that these banks will do well as well, and they would have really come out really well because during this asset test. And these banks have actually gone through 2 really big asset tests in the last 3 years. One is demonetization, and the second one is COVID. So the confidence that the investors will get in these banks about their underwriting and the quality of the book that they are running will actually sort of re-rate these banks as well from current levels, and that's where you might see a significant amount of alpha being generated. Then there are two sectors. There are 2 sectors in the portfolio which make up the total 30%, which are IT and pharma. So that has also been a conscious decision where we are 33% financials, which is high beta, but then there is IT and financials, which is roughly 30% of the portfolio. And these are, in a way, defensive sectors. So even if there is a bit of a volatility in the market and in the portfolio, then these 2 sectors, which is 30% of the portfolio, will do well. And that is what happened during COVID as well. We was again overweight these sectors. And, obviously, as you know, that from the time April to perhaps September, IT and pharma were the best performing sectors. And that also gave us a significant amount of alpha as well. And then we have, we have a growth bias towards our portfolio. So we have a lot of growth companies within our portfolio, such as the chemical names. We have SRF and PI in the materials sector, which are 2 high quality chemical names and best in class in what they do. And they also should do well over the next 3 to 5 years as well. And, coming back to our investment framework as well, which we call SCDV. And since I mentioned that we have a growth bias, at any given point in time, 40 to 60% of our portfolio will be in the secular bucket, which will have growth and ROE as well, above 15%. And the balance is between C and D. Currently, we are 12 to 13% cyclicals and 25 to 27% in defensives. And the balance is in under value/value traps. So we have a nice mix of growth companies, defensive companies. And since we might see a cyclical upturn in the market, we might increase some allocation towards cyclicals as well, but currently we are 12% in the mix. So overall, it's a very high quality portfolio where you will not see, really high quality businesses with growth visibility, with ROEs. A blended portfolio has a trailing PE of 22 times and an ROE of 18%. So, it's in a way in line with the market. With much better growth prospects. So that way we will do quite well. And just lastly, to point out that our market view is cautiously optimistic. And when we move forward towards the next 3 to 6 months, we think that that there will be positive news that will come out, but there could be a significant amount of volatility that can play through as well. So therefore, you need therefore our suggestion is to invest in a multi-cap advantage PMS. So with that, I would hand it over to Sankalpo or Shashi, and if they're happy to answer any questions as well.
Right. Thank you, Mitul. I think Shashi will also, come on for the Q&A session. So what I understand is with an IIFL multi-cap kind of a portfolio, it is like having a night watchman in a test cricket match. When you have a long innings to play for a batsman, that's when you send in a replacement. You don't send your star batsman, right? So, okay, to the audience, an American option is not available in India. The other options were available in India. So let me just tell you, Shashi and Mitul, we ran this poll. The question asked was, given a chance, I would like to at least partially hedge my equity portfolio, at least partially. So 86% of the respondents agreed and 13% disagreed. So, while we begin with that, how is it that you actually can hedge equity portfolio which is as diverse and as multi-cap as the IIFL MultiCap Advantage portfolio? So she touched upon it a bit. You hedge using Nifty Put options, but just can you just take us a bit more into it, either of you? And also let me caution the viewers that this is not an advice. This is more on the academic purpose. So please, no discussions here is to be construed as an advice. Over to you, Shashi and Mitul.
Yeah, so I can take a shot at it, and then Shashi can add. So obviously that's a correct observation that if 45% of our portfolio is in mid caps and small caps, but I think what you need to understand is that this is a sort of a insurance, right? It's a put option that you are taking, and we have 55% in large caps. Right, and a lot of them are banks, and which are there in part of the Nifty as well. So it's a significant amount of the weight of the portfolio is there to be hedged, which is part of the Nifty as well. And what we do is that in a mid cap and small cap, and that we saw it during COVID as well. We did not have that many the correction that we experienced during COVID. In our mid caps and small cap, because they are, high quality mid caps, they did not fall as much as say the banks fell, for example. So we our mid caps and small caps are more defensive in nature and more secular, where when obviously it's not that they only keep going up, they fall as well. But if they fall, they won't fall as much, in this kind of a situation. And therefore, you will be adequately hedged when because of the bank's exposure that we have in terms of the large caps that we have. So overall, on a net basis, you should be fine.
Shashi, anything to add to that, or should we move on to the next question? That the portfolio that one is constructing, if that outperforms Nifty, then when the market falls, the hedging will work. But it could be reverse if the market falls and your portfolio falls even more than Nifty. So as Mitul mentioned, we try to construct a portfolio which is largely Nifty stocks or large cap buyers, and at the same time also try to see that the portfolio outperforms Nifty. Right. Thank you for that answer. So I'll take Mr. Mihir's question, which is a very relevant question again. So Mitul, I think आप ये answer कीजिएगा. So Mihir asks that puts can be expensive too, like they can also be prone to market mispricing. When the volatility is high, obviously puts tend to get expensive, and typically you are looking at longer dated puts. So how is that? Does that have any bearing to your decision of the strike, or the amount of portfolio you want to hedge, or how does that work?
Yeah, that's a very interesting question, and that is exactly what we experienced as well while I was doing these kind of webinars in April and May. Now, Now let's just rewind back to March. So when March happened, the prices of the put options went up substantially, and we sold them because people were willing to pay a substantially higher price when things are looking quite dire. And then for April and May and maybe June as well, we did not hedge the portfolio because it does not make sense to hedge at 7,500 Nifty. So we kept the money in cash, and the 90% of the portfolio did what it had to do. So because we were getting a lot of questions, just like Mihir, as to why didn't we sold the puts, we made the money on it, why aren't we rebuying it back? Because in April and May the price of the put option was still very high. So that's why the time to buy put options is when people are extremely bullish, just as Mr. Buffett says, between greed and fear, that right now is the perfect time, because the price of those put options is between 2 to 2.5% a year, with what that Shashi mentioned. So right now it's a very good time to buy these puts, because you're not paying as much to hedge your portfolio than you would have if this market crashed 30%.
So I should add here that while we're buying 3-year put options, these are not static put options, and we try to so as Mitul mentioned, if the market were to fall and the way it fell in March, we will book profits, and we will wait to buy the new put options till the time market recovers a little bit, or the risk of downside is less and the put options are very expensive. So on both sides, selling the put option or buying the put option, the fund manager will use his discretion to see the cost versus reward analysis and then buy or sell the put options. So to that extent, the portfolios might remain partially unhedged at some times.
But that will be at during valuation levels or the price to book levels that we monitor for the benchmark. That it just does not make sense to aggressively hedge your portfolio when the price to book multiple is say 2 times, where it is perhaps traded 10% of its lifetime there.
Right. So I will take a few more hedging related questions before we actually move on to the more lucrative long only part of the portfolio. So the first question is, is there enough liquidity on these long dated options on instruments? And second, is there could you be looking at this portfolio from a perspective that you could also hedge using stock specific options? I mean, that's also a fairly liquid market in India today. And since you said 55% is in the large cap, those typically that pool of stocks have very active options strikes. So Lalit asked this question, and I think it's very relevant. So over to you, Mitul or Sashi, whoever wants to take this.
Yeah. So in terms of the liquidity, I think obviously as a retail investor or me individually also, if I want to go and buy large volume of Nifty puts 3 years out, I will not be able to get that volume. But because our volume is much more, and we are an institution, there are certain MNC brokers that enable this for us, and that's why they provide us the liquidity on a monthly basis whenever we want to do something, because then they do their sort of prop book hedging and make the puts for us basically. So that is there. And in terms of the second question, I think stock specific put options are not available even for anything more than 3 months. Even the 3rd month options are very liquid, so that just does not make sense, and that is not part of our strategy at all.
Yeah, I should add here that this is one of the main benefits that one gets through our PMS, where we are trying to get some the hedging benefit, which normally is available for all institutional investors, to investors like you through the PMS. If you individually go and you have a 1 crore or a 5 crore portfolio, you want to buy a 3-year put option, it's impossible to get it. And then to sell the put option in the market also becomes very difficult. So it's basically an institutional market, and that's the benefit we are bringing to you.
Right. Thank you, Sashi. So to answer Mr. Ashu's question, the hedging is a permanent part of the portfolio. It's not about this situation or that situation. It's always the portfolio is constructed that way. Okay. So now I'll move on to the more lucrative discussion, which is the long only part of the portfolio, which will actually create wealth over time. So one thing I observed, Mithul, is insurance. Since you earlier mentioned this to be a insured kind of an equity portfolio, you are somewhere underweight on insurance. Okay, the market feels that insurance is the next big thing in India. India is underinsured. A lot of stories around it. So in the BFSI pack, insurance is one thing that is not there majorly in your portfolio. So any reasons to that? Do you feel that there's some the valuations might be expensive or something that you think is not happening clicking with insurance? Over to you.
Yeah. So okay, so as a house, I think we like general insurance more than life insurance. So that is one. It's not that we don't like life insurance. And so general insurance, there is only one stock to play with, and that is ICICI Lombard, which we own, which has done well for us as well. We know this company very well because we were pre-IPO investors in this, and we understand this space really well. So only one listed company to, in a way, speak of. One is other one is very small, which we can't participate, which is Religare. But ICICI Lombard is something that we have, and I agree with you that it's a underpenetrated market, quality businesses out there. And on the life insurance side, I think we prefer one or two names, and I think those are not at our valuation levels. And I think right now, sitting right now on the 8th of December, I think we look at it as a financials basket, right? We don't look at insurance or anything of that. So where we think that risk reward is much better is what we would like to play, and that's why we would rather own more of banks, balance sheet related stuff right now than insurance. So that's why we own only ICICI Lombard right now.
Right. So the view of the world at IIFL is that the other credit-based part is more lucrative in the BFSI space, right? So like you've mentioned this word cautiously optimistic, quite a lot of times, and you gave certain data points to about why we should be optimistic, why the PMI numbers have coming good, auto sales are reviving. Okay, so that's what we are optimistic about. What should we be cautious about in maybe the near term and maybe in a slightly longer term kind of a space, given that we're coming on the back of a huge crisis situation?
So I think one of the things that is important is, and there's on a macro basis, is the fact that India is a growth market. You've seen foreigners have poured in $11 billion over the last 40 days. It's a staggering number. Why are they investing in India? They're investing because India offers growth when the world is starving. I think one of the major things that we have to see is whenever, maybe it's 2Q FY22 or maybe the full year of FY22, we want India to grow, okay, post after we come out of this pandemic situation. So the fact is that we want businesses to grow back to the levels that they were growing earlier, and any sort of delay in that, whatever they may be, which we cannot foresee right now. Maybe a lot of it is pent up there, in this, and a pent up situation might go on till March. We don't know. But, post March, what if this fizzles out? What if in September it's still auto sales are, what they were maybe in September 2019, for example. So we want growth to come back. We want volume growth. We want productivity-led growth. And I think because of COVID, because of unforeseen related factors, if that sort of gets derailed or pushed back a little bit, pushed out a little bit in terms of maybe this happens the year after, then there could be a little bit of a knee-jerk reaction, especially, with the banks. India's GDP, say on a normalized basis, should grow anywhere between 5 to 7%. And if that happens, the credit growth should be, much better. And therefore, the likes of HDFC Bank, Bajaj Finance, ICICI Bank, Axis Bank, all these banks will grow, much higher than the banking system. But what if the GDP growth is 2%, and they grow only 8%? We are not buying HDFC Bank or Bajaj Finance for a 8 or 10 or 15% growth, right? We want them to grow the way they were growing earlier, and that should not be derailed, at any given point in time. So and that can happen because of delayed vaccine. It could happen because of any other political related stuff. You don't know. So that's why it's not 100% given. So that's why we are being a bit cautiously optimistic. Every month that we get these data points, clears out the air a little bit as we get closer towards the next financial year, or just once maybe the second half of the next financial year, where we will have just better clarity as to how things play out. And I think because I think inflation is a bit sticky, and I think the RBI's accommodative stance and that has also been paused for a bit. I think it will be there won't be any cuts or anything till March, in my opinion. So that should not be the case that we are starved of growth and there is still sticky inflation. So that should not be, that will not be a positive sign as well. So a lot of macro things that are at play, which will slowly get sorted out as we move along.
Right. So the risks majorly are in terms of the macro factors that could probably play out at the economic level, right? So a thing that I often like to ask is that one thing that we've understood is in India the auto sector is somewhat resilient. A lot of the big two-wheeler companies have sold similar kind of have made similar kind of dispatches. Maruti is also somewhere coming back to the pre-COVID level. So is this like a temporary pent-up demand or latent demand, or this is something that you see as a more secular trend? And the reason that I ask this is because when you say macro risks are evident in the economy, auto is one of the most macro-driven kind of a sector, compared to other sectors that are there in the index. So what do you feel as a macro proxy auto will do? And what are the risks and what are the rewards that investor gets participating in the auto sector now?
I mean, auto sector is actually it is secular in nature, but I mean, just forget COVID, right? For a minute, the last 2 years were not great for two-wheelers and four-wheelers. It wasn't good for Maruti either, and I think. See, we don't own any auto per se. We own Mahindra and Mahindra, but for different reasons. And we own Balkrishna Industries, which is an auto tire supplier, which is 90% exports. So we don't have an auto exposure per se to speak of. And I think the reasons for that is, there has been a little bit of a question mark in terms of, how the Indian ecosystem or just generally, let's say the bellwether, let's say Maruti, for example, how will they react to the future of mobility, which is EVs, their relationship with Toyota, etc., and two-wheelers as well. Two-wheelers is very, very penetrated market. A significant amount of penetration is there. Significant amount of financing also happens because of a lot of two-wheeler sales are financed as well, more than passenger vehicles. So the previous 15 years and the next 10 years, are quite important in terms of how things play out. Whether will they grow at the same 8-9% volume CAGR that they grew over the last 15 years, we don't know. Maybe it will, but the next 3 to 4 years are quite critical. And it has nothing to do with COVID. It's just because the market is shifting gears quite sharply, and 50% of the market is Maruti. So, as you can see that the latest newer players that have come into the market are grabbing market share. SUV is the incrementally biggest segment that has been formed. And that's where Maruti is not winning as much as they should have. And newer players are coming in and taking market share. So on just that basis, there are certain risks that come through, right? There is BS6, then there is something that's going to come up in another 15 or in another 2 years as well in terms of regulation. Cost of ownership is also rising. People are not stop producing diesel cars as much because the gap between petrol and diesel is also reducing. So a lot of factors at play here. It's not as secular as people make it out to be, or the multiples make it out to be. So therefore, we are we are a bit cautiously optimistic. It might sustain the absolute numbers that we are seeing right now, but on to grow on top of that, we will need the GDP growth, credit growth to come through.
Right. So, Mitul, with that, you come across someone as a very aggressive, yet somewhere very out there kind of a fund manager, because you want to take those bets and you also want to hedge your bets to some extent. So, giving that view of the world, the last question, or the last couple of minutes, or 5 minutes, we want to spend on what is your view on 2021. We've discussed a bit of macros, we've discussed a bit of sectors, IT, financials, banks. So what is going to be the big thing? Is liquidity going to drive the markets again in 2021? Will COVID fears revive? How do you, as someone who has been watching the markets very closely, what do you expect from the markets in 2021 is basically my question.
Yeah. So I've been quite opinionated on one point is that I definitely expect cyclicals to do much better. And by cyclicals, I don't mean just any cyclical. There are and perhaps our way to play cyclicals is different. But I was a little bit turned more positive in August. When I heard the Fed chairman, make two statements, and I've pointed it out in our fact sheets as well, is the fact that interest rates are going to be low for a long period of time, which he mentioned in August. And one thing which is much more important is that inflation targeting in the US is going to be on an average basis. And the exact phrase that the chairman used was hands off the wheel on inflation. What does that mean? Is that they want to target 2% inflation, but it's tough to come by. And all these years they've been trying to raise inflation, but it's not happening. But by average inflation, it means that they want average period inflation to be 2%. And for that to happen, it has to go above 2% for some period of time. And so maybe it goes up to 3%, it stays there for 3%. And when the Fed makes a statement like this, it has a significant impact on everything, whether we like to believe it or not. And when that happens, what does he mean? He basically means he wants asset prices to go up. And that doesn't mean only equity prices. He wants real estate prices to go up. He wants commodities to go up. He wants equity markets to go up. He wants bonds to go up. So that has fueled a significant amount of pro-cyclical rally as well. And I don't think that, maybe some, as I mentioned, volatility, some ups and downs here and there along the way. But I think you will see a pro-cyclical rally in 2021. And that's where perhaps value or, quality cyclicals will outperform a significant amount of the market. And perhaps what has worked over the last 3 to 5, 7 years on the large cap side, perhaps will underperform relative to these names that I'm talking about. So I am personally looking forward to this quality cyclical rally, and those could be the financials, the quality financial names, not just HDFC Bank. I'm talking about ICICI Bank, Axis Bank, SBI, etc. It could be Larsen and Toubro in the infrastructure side. It could be some metal companies, steel companies, where there is volume pickup, there is price action as well. So that's what I believe that you will see in 2021. And that will lead to newer market leaders and newer overperformers in that year than the same safe bets that people have been buying over the last 3 to 5 years.
Right. Thank you, Mitul. That was a very short and quick answer, crisp answer. But I can't resist asking this question today. Now that we've gotten so much talk about a vaccine coming in, how does an investor capitalize the vaccine coming in? Let's say you're an investor sitting in India, your space, your universe, listed equity space. How do you capitalize the vaccine coming into India? We'll take that, and with that, we'll conclude. Over to you, Mitul.
I think market is much more smarter than that. You look at Indian hotel stock, right? Indian Hotel is the owner of Taj Hotels. It is actually higher than, I mean, close to, I think, higher than pre-COVID or very close to pre-COVID levels, right? I think, forget vaccine, I think globally in India, you will see the stocks have already reacted. And I think if India introduces a vaccine, I don't think that day markets will necessarily go up, because I think it's already been factored in. Markets are forward looking. Market will not look at the fact that, oh, tomorrow is the vaccination announcement, so the market should go up tomorrow. I think people are expecting vaccines to come in the next 6 months, and it's perhaps priced in, a little bit of pricing is left. So yes, there are certain names which we don't own, which can benefit, obviously, which are perhaps the cinema halls, maybe some of these hotels, etc. But I think vaccine plays are, I think it's a thing of the past now. I think a lot of things have happened over the last 2 months, and everything has been priced in, I feel. But I don't think investors should look at it like that. I think there are a lot of stocks, regardless of vaccine, which will do well. Vaccine might just add a little bit of fillip to it. There are mall operators, etc., which might do much better, than others when the vaccine situation happens. Retail companies will do much better. Restaurant companies will do better. These are normal. No, I mean, it's a normal answer. But in the listed space, I don't think that there are too many options out there which are really cheap. I mean, if you think about it, PVR, which is a cinema hall company, it's still, I mean, I think it's 4 digits still. So, I mean, even though hardly any movies, etc., or cinema halls have been open. So yeah, I mean, if there was a gym company, perhaps that company would have done well. But I don't think there are too many things left here to thumb the table.
Vaccine plays a no play for you, right? I hope the vaccine comes soon. And with that, we conclude today's call. So I thank everybody on the audience, investors and advisors for being on the call. I apologize if there were any network troubles at my end, which I've been told there were. So we'll try to, improve the next time. Thank you for tuning with us, Mithul. Thank you, Sashi, for being with us on the call. And I think it was a very insightful call. We discussed a lot, and, it was not one of those typical market forward-looking kind of calls. But to know a lot. Looking forward to hosting you guys again. Thank you to the audience. We hope to meet you again. Thank you.
Thank you so much.
Thank you.